Hey everyone, today we are going to talk about wherever there is an opportunity in the market, IIB environment. A lot has happened in the market in the last few days. S&P 500 market dropped on Friday given the China tariff news again. So therefore, there's an IV implosion across the board. So today's task is to pick out which underlying market is actually providing a good risk to reward number and then take a position in there as a contrarian. You may have noticed in my other videos that I like to trade on a contrarian side, meaning when the market goes down, I like to sell puts. When the market goes up, I like to sell calls in the market. Why? Because there's juicier premiums available when you sell into the strength of the market. This is what you call selling into the strength of the market, meaning when the market goes down, the puts are even more juicier because the IV is high and the IV has pumped up the price of those put options. Yes, the IV has also pumped up the price of the call options, but again, the strength of the market is on the downside and therefore puts are more expensive right now versus the calls. So therefore, as a contrarian, I sell puts when the markets go down and then sell calls when the markets go up. Now, remember, I don't sell calls indices. It's a very tough trade I've done in the past with limited success. Most of the time, my calls have been breached because overall, 75 to 80% of the market comes into the market to buy assets. But when they buy assets, S&P 500 is, it has a positive drift to it. 80% of the time, it goes up. And therefore, when it goes up, volatility is always low, meaning most of the time, maybe 70% of the time, volatility is very, very low. And it stays within a very low bound range, which is 15 to 16%. If you look at the historical chart on the average number is around 15 to 16. So what that tells us is that 80% of the time, the market is always going up. When it does go down and volatility pops up, it's an opportunity for us option sellers because we have an edge on the IP side. We sell implied volatility and we sell juicier premiums in these options. So this is where the edge comes in. And let's see if this works out for us or not. Today, I'm going to trade a crude oil market because the market is actually at its bottom and I think it's been oversold. And because it's been oversold, there's an opportunity that there's a risk reversal coming in. And when that happens, it will, the market will bounce up a little bit. So based on those, let's see what else is out there for us to trade given the recent market sell-off. Today, the market is up a little bit, but overall it's trading at 6,700. Drop crude oil market, if you look at this chart, implied volatility is around 32%. It was up and then it's coming down a little bit. So now we have to catch it on the upside. So we're catching the vol on the up around 33%, around 32% in the crude oil market. And on the price action of it, you can look at it here. It's right at the bottom of where it was or it has been in the last 1 year. The low was 56, is currently trading at 58, which tells me that as a contrarian trader, I'm going to get into this market and sell some puts. That's the whole idea here. So price action looks like it's at the bottom. It's a good candidate for a put spread. And we will be selling spreads. We're not selling naked options here. I don't sell naked options in these markets because these underlying markets are too big. I normally trade in futures options, which provides good capital efficiency. It provides good leverage, and you can do twice as many trades for the same amount of money, and I'll show you how. Let's go to the option chain here, and this is my live account. So I'm going to take a position right now and then see if it gets filled up. Now, the only problem here is we don't have a good expiration cycle. The max I can go into is 33 days. My sweet spot is 45 to 50. Right now, I'm getting 33 days, which is slightly on the lower side, but let's see how the market does. Let's see what the risk reward is here in this market. The go-to strike is 16 or 17. I don't like to trade these half strikes. You see this? If you want to see the volume and open interest on these half ones, you can compare it here. So half strike is 3,500 open contracts. The full strike is 14,000. That's the difference. And you can go down the list here and you'll see the same thing. 43,000 contracts here on the 55 strike. But if you look at 55.5, there's not much going on here. Okay. So the half strikes, I don't trade them. People do and they like it. Look at this, 26,000 contracts here on 50. We're looking at the open interest column. Volume is pretty low in these half strikes anyway, but open interest is also low. So the target is to trade full strikes. Now on the full strikes, I have to go to 20 delta here to collect some good amount of premium. Also because we are going into the market with 33 days, right? Not 45. If I were to go into the market with 45 days, I would have selected not a 20 delta strike, but maybe 17 or 18 or 16. But here I'm selling it at 53. I'm going to buy it at 52. One strike up. That's my go-to in this crude oil market. And I'm going to post exactly how these stickers work, futures options work, each market works. But right for now, this is a good average price to collect. This number means 0.15, 15 cents mean that you're collecting $150. This means because the market trades at $10 a tick. So each tick here, 15 ticks, each tick is $10. And therefore, your total net premium is $150. If you want to take your option trading journey to the next level, join my 5-day trading challenge in which I show you how to trade short calls, short puts, spreads, iron condors. We also discuss zero DTE strategies. I've been using these zero DTEs for a while now, and looks like I have had some success with the exact mechanics. For example, which strikes to select, the probability of profit, and then how to get in and out at what time. So all of these things are discussed in my 5-day trading challenge. If you are interested to take a journey forward or further improve on your trading skills in the option space, then please take a look at the 5-day trading challenge link that I've posted here. Secondly, subscribe to my channel and subscribe to the newsletter where I discuss and share a free trade idea every week based on the volatility, the implied vol that is going around, the skew and the surface of implied vols, and how assets are looking for that upcoming week. So drop in a comment if you're unsure about anything. Just ask me a question and I will do my best to answer those questions. Thank you very much. The market is trading at 140, so I'm trying to get one more tick out of it. Okay, let's see if he can get filled. If not, we'll take the 140 just to get it done through the video. Next thing I would like to do here is select my charts, select the break evens, and then display the chart correctly. So 1118 is my expiration cycle, and 1118 is what I'm going to select here. And look at this number now, above 77%, meaning you have a 77% pop. What that means is you have a probability of making a profit is over 77%. That's what we like to see. Over 70, 72%, 73. I like to hit the number 80. I like to like the number 8 in front of everything, but sometimes it's not possible because we don't have enough time in this trade. You know, we're setting it in 33 days. So 77 is still a good number. Now, if you hover over this line, you're collecting 150, your max loss is 850. Okay, so it's a $1,000 trade. 850 is your max loss, 150 is your max premium. Take out 150 from your $1,000 and that's your 850 max loss. Now, the biggest thing here is look at the buying power effect. Now, the buying power effect is the most important thing here. Only for $550. I bet if you were doing this, because the futures market work on span margining, the closer the trade gets to expiration, the more margin they charge you. If you were to start this trade or initiate this trade with 45 days out, this margin number would have gone down to 350 because that's how I normally trade. But because there's an opportunity in the market, I am going to take this trade at 33 days. Usually I would do it at 45, 40 max. But right now we have 33 days and the market has provided an opportunity with high IV. So I'm going to take it. For that reason, we are paying down $550. So we're collecting 150, we're paying down 550. Our risk reward is basically 3 to 1, which is really good in this market. So let's go in with the trade. We've checked everything. Everything looks good. Probability of range is like 68%. This is one standard deviation range. That's where the 77% number comes from. Okay, so let's confirm and send this trade and then see if it gets filled up. If it doesn't, then we'll have to go and change the trade a little bit as well. Actually, let's just change this because it's trading at 14 cents, right? Let's take the trade at 14 cents. There you go. Filled. We have sold one put spread for $140, and I'm going to show you exactly how the chart looks. So we have sold one put spread at $140. Our max loss is 860, and therefore we're just going to wait and see. I just forgot to show you the Greeks on it. So for the Greeks, you have to open up these price slices and then look at the Greeks here. So you're collecting long deltas because you're selling a put spread. So that is going long the market, and then your gamma is basically flat. We need to be careful about this gamma because we cannot let this trade run into the ground with less days to expiration, meaning we will do something about this trade if the market goes against us and our loss is around 100 to 120. So we've sold it for 140. If my P&L number is minus 120 in this trade, I will go and do something about this. If nothing happens, the market keep going up or stays stagnant, then we will take this trade off at 50% max profit, meaning we collected 140, we paid some $7 per commission on it. But yeah, it was about $7 to get in, $7 to get out. So that's $15 in this market. And then we will collect about $80 to $90 from this trade. That's the max target. That's the goal. Stick around 50 to 60% of max profit. Your theta is obviously positive because we're selling the option here, and your vega is negative because we're selling the option. So we are short volatility and we are long delta and long theta. So hope you enjoyed this video or live trade with my audience. Comment, like, subscribe to my channel, and let me know if you're struggling with anything. If you have any questions around anything on option trading, just let me know and I'll definitely try and answer your calls and your questions. Thank you very much for watching. Bye-bye.